Land tax is a big killer for properties, or it's an expense that you need to consider in a feasibility. Partnership is a little bit different to a trust because you don't actually pay or retain any profits or losses in a partnership arrangement. That's why I really like to say to people, have a long-term view when you're setting up these tax structures, because when you sell it one day, that's when you're really going to feel the pain. The most important thing is not tax. Don't think about the tax. If you're paying tax, it means you're making money.
We believe every Australian deserves a right to own at the very least 5 investment properties. I'm Adrian Trimboli.
And I'm Frank Ambezi, and welcome to the Invest in You podcast. Beautiful. Another episode of the Invest in You podcast. Today, we've got George Mitsas from Raft Private. So George is a accountant, born and bred. I think his whole family is an accountant. So he had no choice growing up to be an accountant, from what I know. But today we're going to be talking about, of course, the importance of tax, structuring and protecting your assets. Full disclaimer, this is not financial advice, so please seek a professional, licensed CPA or accountant, or you can seek George and get personal advice tailored to your personal situation. But George, welcome to the podcast.
Thanks very much for having me, Frank. Appreciate the intro, and you're spot on. Family of accountants, fortunately and unfortunately, is the way it was growing up. Most dinners around the table were talking numbers and not really anything else fun, so kind of fell into it without a choice. Fantastic on the disclaimer part as well, because everyone's circumstances and situations are completely different. But that's okay, because we're going to talk about many different scenarios today and all the different types of tax structures that you can buy property in.
Amazing. I guess before we kind of jump into it, George, like what was kind of some of the interesting topics or things that you kind of related with tax, and what made you kind of go into it? I know your family, a lot of your family members were accountants, but what resonated with you, and what was something that made you go down this journey?
It's a great question, Frank. I just have a genuine interest in business. I'm predominantly a business tax accountant, so all my client base is made up of that. However, every business owner is an individual at the end of the day, so we do individual tax returns as well. And with the interest in business, I meet my clients on a monthly, quarterly basis, sometimes annually as well. And on the personal side, that's where they choose to invest in things such as property, stocks, and we cover that side as well. Yeah.
Awesome. And for the listeners, I guess you're kind of, I guess majority of accountants out there, because I've met a fair share of them. They either don't invest in any type of assets, or they might do one or the other, but just they might just dip their toes into doing a little bit of stocks or a little bit of property. But for yourself, I know you're pretty sophisticated. You do all sorts of investments. I know you're big into commercial and doing some commercial developments. It's quite interesting because not many accountants do that. You want to kind of like share a little bit about your journey in investing and kind of what you look at?
Yeah, of course. I'd love to, because I've made a lot of mistakes along the way as well, which I try to advise people to stay away from. However, there's no right way to do anything these days. Well, I guess it all started off when I was 18 years old. I already had a few years of work under my belt. I started off in hospitality, and it was one of the largest cafes in Melbourne. I won't say which one because it'd be free advertising for them. But we were pumping out about 6,000 coffees a day. And as I was the barista behind the machine, cleaning the tables, doing everything required, it kind of just occurred to me, $3 a coffee back then, 10, 15 years ago, these guys must be making some serious money. And it was a family-run business. And that's where I kind of got a bit interested. I worked hard. And the actual business owner at the time, or one of them, he took me under his wing, gave me advice along the way. He said, go to uni, study business accounting, etc. So I continued working there part-time for a long time whilst doing uni full-time and also working full-time as a graduate accountant. I think I said, so I had 3 jobs, or 4 jobs actually at once. And what I decided to do with my money first was not buy a house. I took a loan and actually bought stocks. I borrowed about $100,000 at the beginning, put in 30% and had an LVR of 70. So that was really the beginning of my investment journey. And every month that I got my pay slip, I contributed an amount of money to the loan that was due, and then also contributed another amount of money to the equities on the market. I didn't have an investment advisor. I did it all myself, a lot of research. And what I noticed over the years, the markets went up and down a lot. I saw a lot of friends get into property, and that's where I realized it's an easy entrance to get into equities at the beginning. However, my personal opinion is that when you're leveraging an asset that's worth $400,000 versus 100 grand worth of stocks, you've got growth on such a larger asset. Like, let's say your stocks grow by 10%. That's $10,000 you've earned for the year on 100 grand. If you've got a property and it's grown by 10% on 400,000, you've made 30 or 40 grand, which is 4 times the amount. So I really wished I leveraged myself in a different way. However, it was a great learning experience. I still have my portfolio today. It's growing slowly and steadily. On the property side, got into that recently. The approach was a little bit different. It wasn't residential. I went into the commercial and industrial space where we've purchased a block of land, or 2 blocks actually, and we're doing a development where we're building up to 39 warehouses. That's the project that we're working on. That's going to be hitting the market shortly in the next few months. In between all of that, Frank, I've probably done what everyone else has done: cryptocurrency, play around a little bit, which I've heard is on the rise. I'm getting told by everyone that it's rising up. However, I'm just looking away from that. It's an absolute gamble in my eyes, but money to be made and money to be lost.
Yeah, definitely. I think there was all those people that were talking about the crypto charts and making all these billions of dollars, and now you don't hear nothing from them. So
Mm,
I think that you can't never go wrong with your brick and mortars, and I guess your blue chip stocks and things like that. Of course, they've always done well, and they've always outbeat the market as well. So it's quite interesting. You're doing a big development there with commercial property, and I hope it all goes well.
mm. Thanks,
with
Frank.
with your, I guess, with setting up structures, and I guess people that are listening to this, they are property investors, so they go out there, majority of them will go out there and buy property. They put it in under their own name, or maybe do it, partners with their spouses. Now, getting the right important structure for your asset from the very beginning, I guess, do you want to kind of talk about, like, what are things that you should be doing and looking out for, and when is it the right time? Should you do it at the very beginning, or should you do it once you
Mm.
buy 3-4 properties? Like, what's kind of like, I know we can't give personal or financial advice here, but what are some things that you see, and what's your opinion on this?
It's a great question, Frank, and it's really I can't stress the importance of speaking to somebody before you get into the process too far deep. Setting up a tax structure can take up to between 30 to 60 days, depending on what type of structure it is. And you need it all in place before you go for your finance, because that's what they're going to put on your application. And also, you probably want to do some tax planning depending on your income levels beforehand. So I mean, if you're comfortable, I can jump into the different types of structures that people might consider in different scenarios.
Yeah, that'll be awesome if you could do that.
Okay, so from an individual perspective, the tax rates, it's really a percentage game. As an accountant, we're trying to get you to pay below 30% tax overall, whether you're an individual in business or not in business. So once you're earning above $120,000 at an individual tax rate, you start to pay around that mark of 30%. That's where you want to find other ways, if possible, to basically reduce your taxes, because company tax rates are 25%. Trusts don't pay tax. However, they have the ability to distribute it amongst your family members and yourself. So where I'd like to start is finding out how much income a person is earning. Let's use a scenario. So you're earning $200,000 a year, and that means that you're going to be paying the top marginal rate of tax, which is 47 cents to the dollar. You want to buy a property, you've got a couple of options. You can either purchase the property in your own individual name. This is assuming it's an investment property, purchase in your individual name. If it's positively geared, you're paying 47 cents on every single dollar that you make. So let's say you're positively geared by $10,000. You're losing 4.7K straight off the bat. So you only get to keep half of your profits. If you were to purchase that under a trust structure, all of the rent or the positively gearing of $10,000 that you receive, you'll be able to potentially distribute that amongst your family members or your friends if you've bought your property with somebody else, as an example. If you purchase the property under a company structure, you would pay a flat rate of 30% unless you tick some boxes and you can reduce your tax rate to 25%. Now, the difference between 30% and 47 is a fair bit of money. We're talking $1,700, and that's only one property. If you build up to 5 or 10 properties and you can multiply that, you're talking tens of thousands of dollars that you could save in the long run. The most important thing as well to consider when you're choosing what tax structure with your accountant is your exit clause. If you own the property in your individual name 100% and you sell that property and have a $500,000 capital gain, which is most likely going to happen if you hold it for 10, 20, 30 years, you have to pay all the tax on that. That means that your taxable income is going to be charged at the maximum 47% rate. If you held the property in a trust at the time that you sold it, you would have the ability to split your capital gain amongst your family members and yourself, potentially reducing everybody's income that they've received from the capital gain, making them below the $200,000 a year. That's really the importance of that. In a company structure, you're paying a flat rate of 30% on the rent and also on the sale. So there's no 50% capital gains discount, which actually I should also mention. So holding a property in a company, you don't normally get any tax concessions. Holding it in an individual name and a trust, you can potentially access a 50% discount on the total amount that you sell the property for tax purposes. If you,
So we'll
yeah,
make that
sorry, you go.
clear for the listeners. So if you're, let's say you got the 500 grand of capital gains you've made on a profit of
Mm,
500 grand on a property. If it's in your individual name or a trust, you got the exemption of 50%. So then you'll pay capital gains on the 250 because it's half of the 500. Is that correct?
yeah, spot on, Frank. That's right.
Yeah. And then if it's in a company, you won't get that benefit of if it's under the company. That
Correct. So the difference is, Frank, if you have the $500,000 capital gain, give or take a few dollars or a few percent, in a trust, you'll pay tax at 23.5%, and in a company, you'll be paying it at 30, unless you can tick the boxes for the 25%, which if you're a business owner, you have a high chance of being able to do that.
Now, I want to play like people listening to this, they might be thinking, okay, that's great, but my property might not be cash flow positive right away because of high interest rates. And not just that, I'm not going to have any beneficiaries because maybe all my family members are working and they're already earning over $100,000 or close to $100,000. So really, I've got no other choices. Is there any other way you can get around that, or what's your take on that when people do mention that?
So our decisions are based on a few things. First of all, one thing I didn't mention before is asset protection. If you're in the line of work or in a business where you're exposed or at risk with anything that you're doing, putting your property in a trust might be more important than saving money on taxes because of that asset protection component. Depending on your income levels, answering back to your question, if you've got no beneficiaries to distribute to, it's really simple. The proceeds of what's left will be distributed to you, and you'll pay the tax at the rate that you are. You can set up beneficiary companies to cap your tax rates at 30% and be quite creative with your accountant, but it all comes down to your income levels. Keeping in mind of what I said at the beginning, in regards to earning about $120,000, that's when you start hitting the 30% tax rate, the effective tax rate. So once you're earning more than that, you might consider distributing your proceeds of your property towards a company beneficiary from a trust. It gets a little bit technical. If you've got negative gearing, that's where you can really benefit holding a property on an individual level. You can offset that against most people in Australia have heard negative gearing about 100 million times, I think, and it's a massive selling point, and it's great, especially because this works in reverse for high income earners. Now, if you're earning $200,000 a year and you're paying 47 cents on the dollar, if you negatively gear your property by $10,000, well, then you're going to receive 4,700 back, or the 47% back on the negative gearing in tax, which is great because that helps you with your cash flow based on if the property is negatively geared for whatever reason. If it's depreciation, then obviously it's not affecting your cash flow, and it's an accounting thing. But yeah, there's multiple scenarios. It is tricky. This is a long-term play that you have to make a decision on. A lot of people think really short term and they want the instant benefit now. However, think about when you're selling the property, how much money you could potentially lose when you're talking $1 million capital gain, $500,000 capital gain, or if you've got 10 properties under your belt, 3 properties under your belt, and you want to sell them at a certain point, if you're paying the tax on all of them, it's really going to hurt you. And giving up that flexibility now for the negative gearing component in your individual name, or not seeking advice for an accountant, can cost you hundreds of thousands down the track, depending on what your property portfolio value is. One more thing I just would like to add as well, Frank, is in Victoria specifically, which I'm more familiar with on the state laws, land tax is a big killer for properties, or it's an expense that you need to consider in a feasibility. Holding property in different types of tax structures has different land tax implications, and that's also something to be discussed with your accountant or yourself, Frank, because you'll know about those.
Yeah, definitely, definitely. There's a lot to unpack there, so that's quite interesting. So going back, where if you kind of reach in the threshold of your income levels, if you don't have any beneficiaries, you're saying you can then distribute that to a beneficiary company.
Correct, that's right.
So you create a company as a beneficiary, and whatever the income or even the capital gains, you can distribute
Mhm.
it to that company, and that will pay what a flat is that 30% or 25%, depending on what you set
Correct.
up.
It could be either or, depending on whether you're a business owner or a salary and wage earner.
Okay, interesting, interesting. So that there's a secret or a little golden nugget
Mm,
there because it's quite interesting. People think, okay, well, I don't have any beneficiaries, but then if doing it like this and setting up in the right structure, like you said, you can save yourself
mm.
tens of thousands, if not hundreds of thousands of dollars when you do sell the property in the long term.
Yeah, definitely, Frank. And one other thing to consider as well, which I'd probably like to touch on, I'm seeing this to be quite common, and I've done this myself as well, is purchasing property with other people. I think it's due to such a large deposit required to get into the market, people are finding it hard to save in these times. Teaming up with a friend or family member or a group of people to purchase property is a really great idea in my eyes, because it helps you get in earlier rather than later. And when I was talking about my story of being a stock investor versus a property investor, if you get in the market today into that $300,000-400,000 property versus in 5 years' time, you get to catch the growth. And if the only way to get in is to join up with someone else that you've worked things out with and trust, have a meeting with your advisor. And there's a lot of structures that exist. Just to name a few, you can set up a trust between two people, but it's called a fixed trust. You can both receive the benefits of a trust structure, but there's two people that own it and control it. You can also set up a company between two people. There's a special structure that I really like in particular, which is called a partnership. Partnership is probably one of the most flexible and creative tax structures that exist, which with a group of people can be really advantageous. Partnerships is actually one of the only structures outside of an individual that you can receive negative gearing from as well. So if you can't get the negative gearing effect on your own from the trust, you can get it as a partnership by purchasing a property with somebody else.
So that's interesting there. Okay, so the partnership, I want to kind of talk a little bit about that. So you can use the negative gearing, and I want to talk on it because we do get a lot of people that come to us, and they're it's either a mum and son investing together, or a dad and daughter, or vice versa. And I know sometimes there can be some it can be quite technical because of course if it's a mum or dad, they might be retiring much sooner before the children,
Mhm.
and they go in
Yep.
it together. But I guess having the right structure then it can be a lot more flexible if they were to just do it under their own personal name. So I guess because I know about this, talking about the partnerships, I guess do you want to kind of give it a bit of an example there? Because if you've got a mum and daughter, or a dad and their son, or
Mm.
vice versa, investing in the right entity, that what it can help for an exit strategy and long term gains.
Correct. Okay, so this is a great one, and there's a lot of answers to it. I guess I'll start with a simple scenario. Let's say two family members would like to purchase a property. However, you're two separate entities. One's running a business and the other one's working a job, and you want to keep everything separate personally. So you would both establish your own trust as a starting point, and a trust is essentially an investment vehicle that you can invest in anything you like with, and then distribute your income if you tick all the boxes later on. So that's your starting point. So both of these family members have a meeting, they both come together with their trusts, and their accountant forms a partnership for them. The partnership can be split 50-50, it can be split 60-40, it can be split 99 to 1, however you like. And a partnership is a little bit different to a trust because you don't actually pay or retain any profits or losses in a partnership arrangement. If you have a loss, it gets distributed. So if you make $10,000 of negative gearing as a combined partnership, $5,000 is going to go to each partner if it's split 50-50. And then you can utilize that on any income that you've earned in that trust later on. You can also have companies that are part of partnerships. So let's say, Frank, you and I are investing in a property together, and your income's $1 million a year, and mine's 100,000. It would be most likely that you might be setting up a company to utilize the effective tax rate of 30% or 25%. And it's most likely that I might purchase this in a trust or my individual name because I'm earning 100 grand. We could form a partnership with your company and my individual name or my trust, and we have that complete flexibility. That's where it's really versatile. In terms of exit strategies, if you wanted to purchase a few properties with your family members, you could set up a separate partnership or a separate entity for each property that you buy and make decisions as you go which ones you want to retain. Let's say father and son or mother and daughter. Everyone's got an investment timeline difference. So if one of the two wanted to pull out early, you could maybe choose to retain one of the properties, give control of that property to the daughter or the mother, and then sell the other one in the other trust, and vice versa, and someone can receive the proceeds for that. You've got just an extreme amount of flexibility in trusts and partnership structures. Companies are a little bit more rigid, however, they're very simple and effective when used correctly, would be my opinion. I don't really. The company strategy really works mostly with very high income earners or people in business. If you're in business or you earn more than $200,000 a year, then having a company or a bucket beneficiary company, you could really start to see some benefits and save thousands of dollars per year in tax.
Interesting. And so, what would be different if you done it through a trust? What would be the complications or the hurdles you would run into if you were a business owner earning 200 grand a year and you done it through a trust or invested through a trust?
Well, the good thing is, you always can choose to set up a company as a flow through, because a trust, like a partnership, doesn't retain profit, it distributes it. So you could choose to distribute your profits from a trust into your company that you've set up. We have lots of clients that are earning really good incomes, and we're happy to forego the 50% CGT concession that's available in trust and individual names, and we just pay a flat rate of 30% on all of their positive gearing or on the sale of the property in the future, because we've done the calculations and the cash flows and just worked out that over a 10, 20, 30-year period, you just save so much money just paying company tax rates because you've capped yourself. Can be more advantageous.
Yeah. Okay. So the more, yeah, from a long term perspective, the savings from a tax and then from as well capital gains perspective is going to be much more worth it than under a trust.
Yeah, there's also some great rules around lending, Frank, and I'm sure when people are talking to their brokers to get finance, depending on the level of properties and debt that you have in your personal name, the bank might actually look at it differently if you've got it in a trust that's looking after itself, or if you've got it in a company that's looking after itself. As a team, you really need a great financial broker, and you really need an accountant to work together to work out the best tax structure for you, and also from a lending requirement, because a lot of people really want to leverage themselves to the maximum and grow the fastest that they can. If you want to do that, you just need to meet with both those people, the accountant and the broker.
Yeah, definitely. Because I know with some lenders out there, and if you're a savvy mortgage broker, they don't take in consideration sometimes as well the properties in the trust or the personal name, depending on how you're structuring the deal.
Mm.
So then, of course, your borrowing capacity is going to be much more stronger or higher as well for the next
Mm.
property.
Yeah, definitely spot on, Frank. So it can become really attractive to separate your assets in different structures.
Yeah, definitely, definitely. It's I definitely go down that track because of you start to reach the maximum borrowing capacity under your own individual name, and that's the mistakes I made at
Mm.
the beginning, and now I've kind of tidied that up and had to go down a different avenue. But I wanted to talk about capital gains, sorry, negative gearing in a trust and in a company, because you don't
Mm.
get that benefit when you do invest in these properties that are going to be negative geared, and you put it under a trust or a company, especially now if interest rates 6, 7%, 8%, depending on the
Mm.
individual. How do you lose those gains and those negative gearing benefits, or do they roll forward? How's it kind of work?
So, okay, you've set up a trust. You've bought a property in it 3 years in a row. You've had negative gearing of $10,000. Now you're sitting at $30,000 on the third year. The losses are retained or they stay in the trust, and that means that they're carried forward and they can be utilized at a later date when you do have some sort of profit. So eventually, I mean, you can correct me if I'm wrong as well, Frank, but I would assume safely that these properties, as the mortgages are repaid and as the rent goes up over time, hopefully you don't have any big unexpected costs. However, they can start to become positively geared, or they will. And then as you are receiving the income from these properties when they're positively geared, that's going to start chewing into your losses. So you don't lose them; they stay there forever, and you utilize them over time. That's why I really like to say to people, have a long-term view when you're setting up these tax structures, because when you sell it one day, that's when you're really going to feel the pain. You're not going to feel the pain on the little bit of rent or the positive gearing or the negative gearing now, and you're not really. It's really not worth it a lot of the time. The benefit in a company, the company acts the same way. The company also retains losses over time, and then you can utilize the losses later on when you have profits in the company. But what a lot of people do, let's say you set up a trust and you've got a property that's negatively geared, you find a way to earn some income into it. So you buy some shares in there, you receive some dividends as an example. So let's say you receive $3,000 worth of dividends paid to you for the year just from playing the stock market a little bit. And now you've got $10,000 or $30,000 of property losses. That income that you've received from the stocks, you don't have to pay tax on that because that's going to offset into the property losses, and you get to utilize them across a lot of things.
Well,
So it's
that's pretty cool there. Of you make a
mm,
profit, but then as well you don't have to pay for the tax on that profit.
Yeah, which is really great because a lot of the time with negative gearing, if you're using depreciation on your property, you're not actually out of pocket. And then if you're receiving dividends from your stocks, that's physical cash that's getting paid to your bank account. So you're really winning.
It's pretty cool. You sounded like a true investor there, George, because it's quite funny. A lot of accountants will
Mm,
say, "Oh, it probably going to be a lost nut. Put it in your personal name. You're going to claim the negative gearing." But you just come out here and you said
mm,
the complete opposite. Looking at it from an investment, I guess, and a wealth creation perspective, looking at it long
mm,
term, which is investing is a long term game. It's not a short term. We all know property is 10, 20, 30 years. Same with stocks. You're not going to make a return overnight.
mm.
And if you just sit on it and have the right structure and have the right vision, of course, you're going to be the person that's going to be on top.
Correct. And Frank, that's that long-term perspective as well. Think about the next generation that you might be building wealth for. I mean, we're young guys, and we're building wealth for ourselves at the moment, but we'll get into a point in time where I'm sure we start thinking about the next generation. And the way that you're structured with assets is incredibly important. You do not want to be in a position in 10, 20 years time where you need to transfer a property from your name into a trust or into a company, or just transferring the property alone can incur some capital gains tax and also stamp duty costs, which you've already paid on that property in the past. You don't want to pay those twice. So just getting it right from the start is really important. So when you touch wood, when you're no longer here and you pass away, from an estate planning perspective as well, the trust lives on. So your family trust that you've created, you will elect in your will in the future somebody to take over it, somebody to control it, and you have the power over that. If the property is in your individual name, it's structured a little bit different. So that's also something. If you're trying to create a legacy for you and your family, structuring it correctly from the start can make a difference as well.
Yeah, you see, I do recall as a kid, I remember my grandma passing away, and what happened was, of course, there was six kids, so they had to sell the property within that 2 years because of if not, they'll have to pay
Mm,
capital gains on that. So if that property was in a different structure, will it be? How would it be? Would they get that benefit, or there's a different ways around, not having to pay the capital gains if they were to sell it?
yeah, you're spot on there, Frank. So there's a 2-year rule. Without getting into too much detail on it, depending on what structure was kind of holding the property to begin with, depends on how it will be dealt with. on the estate. It's quite a complex field that if you haven't done your estate planning by the time you're 40, 50 or started to think about it, I'd recommend it because it is important so the next generation doesn't suffer the tax burdens. Or why would you want them to if you can avoid it?
Yeah, definitely, definitely. It's all about setting
Actually,
up your kids.
one more thing, Frank, on the tax structure part, which we haven't touched on, the SMSF, the self-managed super funds, they seem to be a really popular thing lately. Accessing the money to purchase property with. Normally, look, it's an area to be careful with because it's super's designed for retirement, and you want to make sure your retirement's secure, and that's what these industry funds are doing. However, if you feel ambitious enough and confident enough to take control of your own funds, you have the ability to set up an entity which kind of acts like a trust, and that's what an SMSF is. It's a trust, however, you do pay tax. You pay a flat rate of 15% tax in your self-managed super fund on any profits that you make in it. So it's a super tax effective vehicle that Australians love to utilize over time. And once you turn 60 years old, all of the income that you receive from your super fund is tax free up to a certain limit, depending on the rules and regulations. Now, these are changing all the time, so big disclaimer here. They're looking at these changes on a daily basis, so I don't want to say something and then it gets changed tomorrow. However, the tax concessions are huge in superannuation, and if you've built up funds that you believe are large enough to do something with, and you want to take control, it's an easy process to see your financial planner or advisor and work that out.
Is there a certain amount of money you can hold in a self-managed super fund, or is there like a limit?
No, no, from my understanding, there's no limit. However, advisors would normally make a recommendation that you have a substantial amount of money in there before you set one up. It's quite expensive to maintain a self-managed super fund. You could be paying thousands of dollars per year just to complete the tax lodgements alone. They need to be audited, and you need to follow strict guidelines and rules. So you want to have enough, perhaps two to $300,000. A self-managed super fund can also have up to 6 members. So if you can find 6 people to build up your balance, it could also become worthwhile for you all to purchase a property. Another way to do it is you can set up a self-managed super fund with your own super and your partner or a friend, and then you can join up with your personal funds and you can set up a trust with the super and your other trust and use your personal funds and your retirement money to purchase a property altogether as well.
Oh, that's interesting. So you collaborate, you buy something, you probably buy something, 2, 3, 4 million, maybe it might be a commercial deal, whatever it may be, and it just
Mm.
gets you into something much more bigger and significant with a bigger return on investment than a little small property, a smaller property if you were to do it solely or solo, I
Yeah,
should say.
yeah, that's right. That's right.
It's
Mhm.
interesting, interesting. And with that, is it any new laws or anything that's come out with investing through a trust or a company or things that are that I guess not the average Joe will hear out on TV or in the news articles that are things that people can look out for or understand for their own personal benefit.
The greatest thing that's happening actually in the next financial year, the tax rates are changing. Earning the first $200,000 as an individual is going to change to 30%, which is
What do you mean
incredible.
by that?
So the effective tax rate, you're going to be taxed at 30% up to the first $200,000. So there's going to be, I could find out and just confirm the numbers, but you might be saving ten to $15,000 as an individual earning the same amount of money. The ATOs or the government are trying to stimulate the economy, tax the rich more. However, give the middle class a nicer break, which is nice. It's good for everybody. It also changes the way we approach tax structuring as well. We have to factor in those new tax rates that are going to change. The most creative way you can be, Frank, is when you're a business owner. It is difficult as a salary and wage earner. However, setting up ways of utilizing that negative gearing and then earning investment income at the same time is probably the most creative way to build wealth the fastest, which we discussed before.
Mm. That's yeah, it's definitely is. If for the people, I guess, listening, and maybe new to this, can you paint an easy picture to understand? Or I know we're talking here on, and we've got a video. So if you're listening to this, probably go to YouTube. But is there anything that you can kind of paint the picture in their mind of how they can kind of look at that and understand that and comprehend what you just said there?
In terms of the tax rates, are you referring to?
No, yeah, through the distributing the losses through the company or the trust if you're a business owner.
Oh, of course. Okay, so as a business owner, when you're depending on how you set up, there's a special rule with companies. It's the 20/80 rule, and when a company receives more than 20% of its income as business income, this is when you have the ability, or you flick over to a different tax rate and you become a different type of company entity. You become a small business or base rate entity that pays 25% tax instead of 30. So you can save 5% on all of the income that you earn, when if you're earning 100 grand a year times by 10 years, you're going to save $50,000 over 10 years, which is a lot of money. And that's only talking about earning 100 grand. For people in business, it's going to vary year on year. It's a bit of a smart approach, that's a little bit creative and different, that you won't really find the norm, I would kind
Interesting.
of say.
Interesting. So especially if you, like you said, that's 100 grand. If you're earning 2, 3, 400 grand as a business owner, that's tens of thousands, hundreds of thousands of dollars that you'd be saving.
Yeah, correct. It really adds up. It really comes down to how you're structured in the business as well. We have performed restructures of businesses to get them into structures that work better for them, for commercial reasons as well. You're not allowed to do anything for tax reasons; that would be illegal. However, there's a lot of commercial reasons why people would change tax structures if they're bringing in different shareholders, investors, etc., or they need to trade differently. But yeah, there's a lot of creative ways to reduce your taxes to find that 25% in the company.
Yeah, and I guess that's where a professional like yourself that's very savvy and I guess savvy as well in investing in different types of assets. That's where you come into play and help with help minimizing tax, but more importantly, help them build wealth through their business or
Mm,
their investments.
yeah, look, it's another thing as well, Frank, that I touched a little bit on land tax. When you start to accumulate a fair bit of property in the same entity, the SRO, the State Revenue Office, charges you a surcharge on the land tax that you're going to pay when the property is held in a trust. I've got an example. Let's say you're holding $4 million of land or property that you're being assessed on, and you've got a company that's holding 4 million, and you've got a trust that's holding 4 million. The difference in the land tax that you're going to pay is about $30,000 between the two each year. So as you can imagine, 3 years later, you've paid an extra $90,000 by having the property held in a trust that's that size. If you
So the
fast
trust will pay a higher land tax threshold.
Correct. Depending
Okay.
on the value of the property and how many properties you have in there and what their value total. So this is why it's really important to understand the investor's goals when they're meeting with their advisors. Long term, what are they trying to achieve? What state is the property being held in? This is also going to impact the tax structure and the decisions. And if you double it, and the properties are worth $7 to $8 million, the company and the trust, there's going to be about $120,000 to $150,000 more land tax that you'll be paying every year in a trust in Victoria versus a company. It's really hurting people because traditional accountants, love trusts. That's the first thing they go to a lot of the time. They don't like the idea of setting up properties under companies. It seems to be now that we're seeing all these new ways to find or to kind of have greater tax outcomes by structuring it differently. And look, this is all subject to change as well. Our conversation today, if the company tax rate changes tomorrow, we don't have control over that. However, we do the best that we can.
Yeah, definitely.
That's
That's a big eye opener. I say to people, I talk about diversification in the portfolio, and it's, of course, don't put your eggs in one
Mm,
basket. And one of the things we look at is, of course, there's different economies in every state and territory, but of course the land tax is very important too,
mm,
because every state has different land tax rules. So Victoria is going to be completely
mm.
different to Queensland, WA, and whatever it may be. But that just blew my mind, because I didn't know the complete difference. Of course, we've got a $4 million property. Not everyone out there can go buy a $4 million property, but a 30 grand difference per year in land tax, that's it. That can make you or break you.
Yeah, well, the thing is Frank, you're right. We don't start off with these $4 million properties, but what about when you and I are 60 years old or 70 years old, and our portfolios have gone three, four times what they're worth today? They're going to be worth 4 or 5 million, hopefully, if we keep on purchasing, and following a strategy. Or most of the people will be that have started buying property in their 20s or 30s. So, so really, that's when it hurts you, right at the end. Just when you want to retire, you want to sit back and you want to enjoy it, and here comes the land tax bill.
Yeah, big whack.
Yeah, yeah, that's right.
Big whack. Well,
Mm,
George, I've gotten a lot of value, and I guess the people listening will definitely be getting a lot of value, because, once again, I think you bring a little bit of a different view and approach when it comes to your traditional accounting 101. I want to kind of close out with this question. I guess, when you're making an investment decision, are you making it purely on a negative gearing or tax saving perspective, or are you looking at it from a, an income or wealth generational perspective, which I know which you're going to go down, but a lot of people target more your negative gearing side of things.
mm. I'll be completely honest with you, Frank. I don't think I've ever made a decision in my life that's been for tax purposes. When I'm investing to build my wealth, it's the most important thing is not tax. Don't think about the tax. If you're paying tax, it means you're making money. The negative gearing aspect. Perhaps if the property is negatively geared, you get the tax benefits. Sure, you do. Um, you hope that it grows in capital value later on. That's why I guess you would invest in a property like that, or from my perspective as well. Yeah, that would be my short and sharp answer to that question.
Yeah, I like it. If you're paying tax, you're making money. It's funny, you hear business owners, I
Mm,
didn't pay tax last year, I got a good accountant. And it's like,
yeah.
and you're like, oh, I'm not sure about that.
Yeah, that's right. My best clients are the ones that love paying tax. Frank, they walk in, they put their hands together and they smile and they say, "All right, what's the bill? What's my business partner's bill today that I got to pay them?" It's at the end of the day, you're in business with the government and the ATO. They take their share of the pie. Unfortunately, and fortunately, they look after the state. They pay for the roads. They pay for a lot of things, and all that's where all our money goes. It doesn't always get used the best. This is getting onto a little bit of a political topic, but um, paying tax isn't a bad thing. That's not the way you should be analyzing and looking at your performance for the year. How much tax have I paid? It's there's so many other metrics that are much more important to be reviewing. That tax is important, but that will be fine if you have a good advisor that's looking after you.
Yeah, well said. Yeah, totally agree.
Mm.
So thanks again, George, for your time. I guess, for the people listening, where can they find you, and what's the best way to contact yourself and the team at Raft Private?
We have a website, Frank, raftprivate.com.au. That would be the best way to contact us. We've got an office phone number there, and an email contact box. If anyone has any inquiries, please feel free. More than happy to assist and help out. Thanks very much for having me. It's been great chatting with you, Frank, as always.
Nah, beautiful. I think we will probably do another episode, I think, in the future as well. Probably get a bit more sophisticated and talk about different, the intrinsics of the structures, and give it a different view as well. So we'll have you back on in the future. But thank you for
Yeah,
jumping on. I think a lot of people definitely got value from today's chat.
thanks, Frank. I'm looking forward to it. Looking forward to seeing you next time. Thanks, everyone.